Hi to all. So in the previous video, we formed a short iron condor, which basically we started with a net short position. We ended up with cash in our pockets, but we may form an iron condor in a different way as well, which is a long iron condor. So with a long iron condor, um, in contrast to what we did here we chose a bull spread. We formed a bull spread with put options, bear spread with call options. The way to form a long iron condor is well, in essence, we will basically use those options that we have been using, respectively, for a bull spread and a bear spread. We have been using call options for a bull spread. We have been using put options when we form a bear spread in order to avoid early exercise risk. So if we use those appropriate options in the bull and the bear, we use calls and puts respectively, then we will end up with a net long position when we form the iron condor. Why is it a net long position when we form the iron condor? Well, if we form a bull spread with call options, then in the bull spread we are going to buy the low strike call, we're going to sell the high strike call. So we're going to pay in order to buy the low strike call. We go let the columns K, L, M. There's these are this is where we have the information for call options. So we will buy the low strike call, which is this is the premium, and then we will sell the high strike call, which this is the premium, by the way. So this is an outflow, right? Let me change. In the previous video, I changed this notation, C1, C2. I changed it to C3, C4. The same thing I did this, I did here. Let's do it here as well so we can identify it better. So that then the second thing is we will form the bear spread with put options, right? In the bear spread, we're buying the high strike, we're selling the low strike. So let's buy the high strike, and the high strike of the put options is basically that put option that has the higher premium, and then we're going to sell the put option with the low strike, which is the one with these $3, right? So if we look at this, then we multiply by 100 the number of options, the number of shares controlled in a contract, and then we add these two, we end up with minus $1,200 outflow, an outflow of $1,200. So we have to make an initial investment. So that's why this is a net long position. So this we can think about it as a long iron condor. Let's fill up these numbers quickly. So now we are experts. So we just need the intrinsic value of call option C3. So that would be the price of a stock minus the strike, which is X3. We lock this strike because I'm going to scroll the cells down, comma 0. Then the intrinsic value of C4, which is the stock price minus the strike price X4. And then we lock this cell or 0. And then we can move this down or scroll this down, right? Let's keep in mind that the profits from a spread, the money spread, is coming from this difference. We see that there's always a difference between the intrinsic values of the two. That difference is the result of the different strikes, right? So once we have the intrinsic values, we calculate the profits. This is a bull spread with calls again. So in a bull spread with call options, I am buying minus, I am buying the low strike call option. So I am paying $8 for that, for each option, and I can lock this sell. Because I bought that call option, then I am entitled to its intrinsic value. And then I'm going to sell the high strike, the strike X4 call option, which is the call option with a premium of $2. I'm going to lock that, and because I sold it, I wrote it, then I'm going to be liable, or I'm going to lose. It's we can think about it as I'm going to lose the intrinsic value. So because I locked the cells, the premiums, right? I can scroll down, and the moment I scroll down, we see that, yeah, this looks like a bull spread because it's negative. We have losses when the stock prices are low, and then we have profits when the stock prices are high. And these losses are constant, these gains are constant, right? There could be a point in which there's a little bit of a diagonal line, but here we cannot see it because we are having increments of $50 on the stock price. But that's a very short range of values that would give you a number in between -6 and 44. If we had a dollar by dollar per dollar, we were looking at dollar increments, we could see that. But here we just see it as -6 or 44, right? Then we multiply this by 100, and there we go. There we go. Now a bear spread with put options. Let's first calculate the intrinsic values of these put options because this is a bear spread. Well, let's just get the intrinsic values first, right? P1, so that would be strike X1, max of strike X1 minus the stock price, comma 0. And then P2, max of strike X2, we lock this one, minus stock price or 0. And then we can scroll these two down. Now we get the profit. So because this is a bear spread, right, we're buying the high strike put, which is the one with a premium of 9. We lock this sell. Because we bought it, we have the right, or we are entitled, we will receive the intrinsic value of this B2. And then we are selling the low. This is bear spread, so we're selling the low strike, which is giving us a premium of $3. I lock that premium, and because we wrote that put option P1, then we are liable, or we lose any intrinsic value here. And there we go. Now I scroll this down, and we can see that this looks like a bear spread because we have, when stock prices are low, we have our profits. When stock prices are high, we're losing money. Then we multiply this by 100 because when we multiply by 100, then we get the contract. And well, finally, we just add these two contracts. And when we add these two contracts, now we have a gain on the extremes, and we have an area where we can actually lose money, which is these a range of values when stock price is between the middle strikes. Out of the 4 strikes we have, between the middle strikes. Once again, we can do this, and we can select data, so we can include all the stock prices here. So here we go. So in this case, we do not necessarily start with a profit if stock price is between the middle strikes. Probably then, when we do this, we are starting with a net, uh, with an outflow. I mean, to form the portfolio, we will start with an outflow. So we make an initial investment, and then what we're betting on the stock moving either up or either down significantly, at least moving past those middle strikes, the area defined by the two middle strikes. And as long as that happens, we end up with profits, and we know that the profits are 3,800, whereas the maximum loss is the 1,200 that we will actually need to form the portfolio. We will need that money if we even if we want to form it for the very to begin with it, right? So then here we have the long iron condor, and now we understand the difference If you look at the previous video where we worked on the short iron condor and now the long iron condor, these are the main differences. And by the way, this is something you could do. We have looked at buying the iron condor, selling the iron condor, but you could do this with any other strategy. Like for example, if you take the straddle, you could sell the straddle, right? And rather than buying those put and call options, you could write the put option and write the call option. Um, and the only difference with the straddle is that then on the short leg of the portfolio, which is a call option, you would have unlimited losses, right? You can, for fun, you can just go and prepare a chart where you are actually writing a call option, writing a put option, and then you can check what it looks like. Okay, so thank you for your attention. I hope this video was helpful, and then let's keep in touch.